Video number 3, Due Diligence and Risks. In this video I will discuss the use of hard money in business lines of credit and how the cap rates play a part in deciding whether to purchase a property or not. I'll give you a couple quick examples and we'll conclude with a quick checklist of what to expect from lenders when you apply for funding with them. First, I'll talk about the use of business lines of credit or LOCs. Look at the investment below. Would you invest in this property? Why or why not? We have a 12-unit apartment building. Asking price is $1.25 million, and the net operating income is $125,000. The owner says he will carry 20% with you putting 10% down. Commercial financing is available. Here's how it looks. You put 10% down, which is $125,000. You use your business line of credit at 11%. The owner carries 20%, which is $250,000. That's 5 years at 8% interest. The bank will finance the rest of the 70% LTV at $875,000, and you get a loan for 20 years at 6.5% interest. Quickly, would you buy this property? I hope you answered no. At first glance, it looks manageable. Let's take a look. $125,000 at 5 years at 11% is $1,147 a month. $250,000 at 5 years at 8% is $1,680.72 per month. At $875,000 at 20 years or 240 months at 6.5% is $4,739.58. Your total monthly debt service is $7,567.30. We take this $7,567.30 times 12 months and we come up with $90,807.60 per year. Your net operating income is $125,000 per year. So it looks like you're going to make about roughly about 15 or 25 to 30,000, which could be okay. It might. Well, as you can see, this might work, but we must remember that although expenses are factored in first, we must also leave some room for taxes, insurance, and a contingency or reserves for emergency uses. Remember too that the cap rate will change if you have vacancies in the unit. Even though you have 12 units for rent, even one vacancy can tilt the balance for even one short month. For expenses, a general figure would be to use 50% of gross earnings or revenue. This could also be used for non-real estate businesses and non-real estate business transactions as well. Okay, here's another potential deal. Would you invest in this deal? Why or why not? 4-plex rental unit for sale. Asking price is $235,000. Net operating income is $17,400 with a cap rate of 7%. The owner needs cash for another property and was looking for a 1031 exchange, but you offered them 20% down and got a bank to finance the difference at a great rate of 5.75% for 30 years. However, the line of credit you are using as the down payment is at 15% interest. You're motivated to pay the line of credit off quickly, so you plan to pay it in 5 years or amortize it for 5 years. Would you buy this property? I hope you said no on this one. $235,000 at 20% gives you $47,000 over 60 months. That's $783.33 per month. Your next payment, the 80% will be $900.83 per month, amortized over 30 years at the 5.75% interest. Your monthly debt service will be $1,684.16. We multiply that by 12, we come up with $20,209.92 per year. Your net operating income, remember, was $17,400. So as you can see, you would be $2,809.92 in the negative every year. Not a good deal. Okay, at this point you could ask the owner to sell for less, and for the sake of argument, let's say that he agrees to a $20,000 reduction. Now you have a new cap rate of 8%. Without going into complicated math and explanations, here's what it would look like very quickly. Your monthly debt service would be $1,540.84 per month. So your annual debt would be $18,490.08 a year. You're still upside down by $1,090.08 every year. Remember, the net operating income is still $17,400, as in the previous example. Okay, one more try here. Let's say that the seller really likes you and wants you to take her property off her hands, and she gives you a $50,000 price reduction. Here's what this will look like. We started off with $235,000. This is still for the fourplex, and now our selling price is $185,000. We have a cap rate at 9% now. Okay, so the 20% down payment that you're going to put down for the property using your line of credit at 11%, or I'm sorry, 15% will be $616.67. The 80% that you get for conventional financing, once again, 30 years at 5.75% is $709.17. Your monthly debt service is $1,325.84, and your annual debt will be $15,910.08. Yeah, remember your NOI is $17,400, but what about taxes and emergencies? As you can see here, you have just a little under $2,000 on an annual basis to cover any such things. Maybe you have to replace a washer and a dryer or a refrigerator or something in one of the units, or who knows? Maybe you have a vacancy and you got to clean it up, and maybe the deposit wasn't enough to cover the costs. I mean, who knows? There's all kinds of things that can come up, but anyway, you'll still come out like maybe about $1,500 ahead, $1,600 ahead per year on this deal. But is it really worth it to go through all that just for such a small return? There's better ways. So as you can see here, that any use of hard money or business lines of credit is going to be extremely tough to utilize in a long-term buy and hold investment. In almost all cases, you're going to be upside down on your cash flow, and we recommend that you don't use hard money or lines of credit for buying retail and or long-term investments. And we are talking of both real estate and business entities. I'll cover what to do with business lines of credit and hard money for long-term investments in another video. At the beginning of this video, I mentioned that I would tell you what hard money lenders are looking for. The requirements of hard money lenders are: 1. How much do you need? 2. How do you plan to pay it off? 3. What is your exit strategy? And 4. What is your backup exit strategy in case all fails? Okay, these are just the basic 4. There are more. However, these 4 should get you off to a good start. Now, I've had some borrowers approach me and say, well, I'd like to get this X amount of dollars, and this is the interest rate I'm willing to pay for it. Well, sorry, you don't get to dictate the interest rate. Sure, we would all like to have a low rate, but they, the lenders, in turn want a higher rate. This is especially so because they are transaction-based and willing to cut you some slack on personal credit and other conditions. However, to compensate for their risk, they charge a higher interest rate. And unfortunately, that is not really negotiable. You can't say, please give me a lower rate. It just doesn't work. We'll have to work with their interest rates, what they charge, and just do our due diligence and make sure that our numbers come out positive for us before we jump into the deal. And of course, I'll be there to help you with that and assist you with that if you'd like. Okay, in the next video, that'll be video number 4 in this series, I will show you how to utilize hard money and business lines of credit to make money in real estate investments. Okay, I'll see you in the next video. If you'd like a copy of this video in PDF format or any more information whatsoever regarding the services that we provide and the lenders, some more information on the lenders that we work with, please send an email to me, Andrew, at the address below. That would be pnwcorpfunding@gmail.com. Again, that's pnwcorpfunding@gmail.com. You can also visit my website, bestbusinessfunding.com, and there's an online application, very short, very simple. You just plug in some numbers and some information. All the information is secure and private, so we don't give this out to anybody because we value you as a customer and we wouldn't want to share you with our competitors anyway. So feel free to go in there and check it out if you'd like. Okay, well, I'll look forward to seeing you then in the next video. Thanks again.